Wait it out. Wait until there's more production of everything. There's more materials. There's cheaper prices. If you start looking back and you look at the cost of remodeling a house or materials to remodel a house, they skyrocketed over the last 2 years because there was not enough. That's the reason mainly, right? And even with the prices that they had, people were still purchasing them. People were still moving on with remodeling the house and doing whatever they needed to do, right? So I'm not saying don't do anything because that's not the message, but pick and choose which ones are the ones that you have to or you want to take care of, right? Um, so that's what's happening with the Federal Reserve increase. Now, the Federal Reserve is coming to a stop pretty soon, okay? Because they feel, or at least the communication from the Federal Reserve this past meeting was that they feel that we're taking care of inflation, okay? And we have only achieved a soft landing, I think, once in history. So it's like a pretty, it's a pretty rare thing that we're planning to do. It's not something that happens regularly, but they have done well. So last year, if you heard everybody on the street, on Wall Street, pretty much everybody was saying, oh, the Fed are taking us right into recession and they're just driving us down to recession. And the market kept going down, and yes, the reaction was that the market went down and touched about a negative 25% from the top, right? But the market has reacted correctly to the changes that they made because inflation has been taken care of. Okay? Now we see inflation going down. Now the Federal Reserve is lowering the pace of increasing interest rates. So if they do it at the right time, they might achieve that soft landing. Now most experts are talking, they're talking about, hey, it could happen that we have this soft landing, and the recession that we were expecting is just a very mild recession, not an acute one like we expected before. So that's what's happening. Those are the good news. And we've seen a good reaction on the market. Market is up 7% from January 1st or January 3rd when we started seeing the market behave, right? Now, bad news, we're still in shaky waters. We're still in the volatility waters, right? It's going to still be volatile. It's still going to go up and down a little bit. It's not a steady growth yet because of what's happening. The other, point here with the news in the market is this past week, by the end of last week, the job report came out, and it wasn't what we expected. We expected unemployment to increase, because if you have more people unemployed, there's less cash flowing. So inflation should slow down. And the unemployment, the jobs report that came in said that we increased jobs by like 517,000 jobs, new jobs in the month of January. So that wasn't positive for the whole equation, right? But the market took that punch very well. It went down a couple of days and then it just rallied back up. Okay? And it's been like that. It's been absorbing those punches like 1 day, 1.5 days, and then picking back up. So we're seeing some change there, right? We expected this first 6 months to be choppy, to be up and down, and then we expect that second half of the year to be better for the market. That's our expectation as of right now. Okay? But today we weren't going to talk about the market. It was a quick update on that, right? We're going to talk about taxes. And so, good thing that you brought that up, because when we talk to our clients, there's 5 areas that we talk to our clients about usually. Okay? One of those areas is the income and the investments. And obviously, income will depend on the economical situations that we have. Investments will depend on that as well. But then there is healthcare, which we've talked about in other seminars. There's estate planning, which is legacy planning, and we've emphasized on that by the end of last year. And today we want to talk about taxes, a little bit about taxes. And taxes, to me, is the silent killer of your money in retirement. Okay, people don't usually know how to handle taxes. Taxes are the most complex thing. That was, I think it was um, Albert Einstein that said that. They're the most complex thing in this earth, right? Um, because nobody understands taxes pretty well. Now, um, if we're talking about retirement, one of the first questions that most people ask, and this is, she just came in, and as soon as she came in, that was the first thing that she asked me was taxes. I got my Social Security report. Am I paying taxes on this Social Security, right? So is Social Security taxable? Yes, it is. Okay, Social Security is taxable. Is that fair? Absolutely not. You already pay taxes on that money. So yeah, I agree with you. I'm with you. I'm on your corner. I'm rooting for you. There's nothing that the government is going to do to change that. Okay? They're going to charge taxes on Social Security. But they do only charge taxes on Social Security if you exceed a certain amount of income. Okay? So they have something called combined income. And combined income is the addition of your adjusted gross income plus non-taxable interest. If you have any municipal bonds, that will apply to you. If you don't have municipal bonds, don't worry about it. If you have any Roth IRA that shoots out income or interest, a Roth IRA is non-taxable, but it will be included in this figure. And half of your Social Security. Okay? So they have this formula to figure out if you have to pay taxes on your Social Security benefits. If you add your income, let's say that you're working a part-time, you're making $30,000, and you have, or you don't have any interest, but you add that $30,000 or $25,000 that you're making a year, plus half of your Social Security, okay? And let's say your Social Security is, I don't know, $24,000 a year, so that means 12. So if you have, let me do this right here. If you're making 25 on that job, right, as salary or tips or whatever that is, and then you have half of your social, which is 12,000. Let's say you're getting $2,000 a month. Okay, you have to add these two. That will put you at $37,000, right? If you're single, right, and your combined income is between 27 and 34, then 50% of Social Security is taxable. If you're single and the addition of these two, it's between 32 and 44. I'm sorry, that's joint. It's over 34, then 85% of Social will be taxable. What does that mean? This is half of Social, right? So the full amount will be $24,000. That means that at that point, the government will get 85% of that and count it towards your taxes. You will pay taxes on that money. Okay? If you exceed those thresholds.
37.
Well, 25 to 34, 50% will be taxable. Over 34,000, 85% is taxable. Okay?
Poverty line is 30,000, no?
It's about 20. It depends on the household. Depends on the household. Okay? So, yes, it's not fair. I know. I'm looking at your faces. I know it's not fair. I agree with you 100%. I don't make the rules. Don't kill me. I'm the messenger. Okay? Now, that's not going to change.
So I have a question. So no matter what, you're going to pay $24,000. If I don't have an extra job or anything, so no matter what, I'm going to pay.
Good question. I'm going to resolve it here. So let's say you don't have any job. Mm-hmm. So there's no more income. There's only Social Security. Mm-hmm. If your Social Security is $24,000, half of it is 12,000. If you don't have any salary or any income from any job, then your combined income, it's only 12,000. At that point, you're under the 25,000, so your social is non-taxable. Does that make sense?
Yes.
Yeah? You guys got that, right? Are we all in the same page up to that point?
So
Perfect.
I could make $12,000.
You're getting to it. You're getting to it because now we're going to start talking about a little bit of a strategies, right? What if I have, Miguel, I don't have any salary, right? Because I just retired. I'm not working anymore, and I'm not going back to work. But it happens to be that you guys handle for me this vehicle called an IRA. And you guys have my IRA, which has my lifetime savings. And I know that that was tax deferred, and now I'm going to start taking money out of that. What's your next question? Because I know you got a question now.
Well, I can only take $1,200.
What's the maximum I should take? You should not take any more than $12,000 if you don't want your social to be taxable. Does that make sense? If you don't want your social to be taxable. Now, if you don't care about a portion of it being taxable, then you take a little bit more. Now, obviously that, changes from household to household. Everybody is different. So like some people will say, okay, I'm okay taking the 12,000. I don't need them. Some people will say, no, I actually need 24,000 coming out of this IRA. I need $2,000 a month to be able to, pay my bills and do everything that I want to do. So at that point, yes, a portion of your Social Security will be taxable. Is that fair? No, I agree. It's not fair. But I just got to let you know. Most people that work for the state and have a pension, guess what happens with that pension? It's not considered salary, but it's considered a pension, and it's taxable. So if your pension was that $24,000, yes, it throws you off.
We have to pay for it.
You will have to do
taxes on the pension too.
Pensions are taxable.
Plus 50% of your
Pensions are taxable, yes.
Even though it's less than 24,000.
No, it depends. You have to do the math. That's why you got the formula. Depending on where you land, every single person is different. That's why we don't hold a meeting for everybody, because everybody's going to ask me their own situation. I have to meet individually to look at your numbers and say, hey, this makes sense or this doesn't make sense. But when I do have meetings, and when we all have meetings, by the way, because this is not just me, all the advisors here know this, they will automatically tell you, okay, well, a portion of your social might be taxable. So it depends on how much do we want to take. Is it a good thing? Is it a bad thing? Some people, right? Some people think it's good. Some people think it's bad. As we go through the presentation, you'll find out whether it makes sense for you or it doesn't make sense for you.
Just in case we can receive credit for it when we declare the taxes.
Receive credit for
different things that we do it for travel, for...
That depends on the type of business you have. That is a different story. If you're an employee, you have no credit for nothing. You're an employee, you get a W-2. If you're a 1099 and you're a business owner, then that's a different story because you handle your own business. So your business usually has expenses, right? Usually, this business, we had to spend money on getting the chairs, we had to spend money on paying the light bill, we had to spend money. It's different. So every situation is different for everybody. For the ones that are employees and have a W-2, it's very tough. I get it. It's very tough.
Retire at 62, they get less money, right?
From social, yes, they get 30% less. If you pull the trigger on social at 62, they're going to cut your benefits by 30%. Meaning if you were going to get $2,000 every month, they now expect to receive $1,400. Okay, 30% less. And that's going to be for the rest of your life. That doesn't increase when you get to a certain age. Yeah. So this is important for you to know. For most people, it is important to know because most people don't know what to do when they get to that place, or if it makes sense for them to start pulling the trigger on Social Security. Or some people think, hey, I'm gonna be paying taxes on that money, so like it doesn't make sense for me to take it, right?
Then it's better when it's a joint.
Yeah, when you're married, the threshold is higher. When you're married, you got up to $32,000 that you can make, and you don't have to pay taxes on social. And then from 32, yeah, there are some things for which a marriage is good for. I know, just a few, but there are some things. I could argue otherwise, but yeah, it is. And taxes is one of them. So taxes, I paid a visit to the accountant this morning.
Great point.
I paid a visit to my accountant this morning, and I was happy to tell him that I'm married now. Last year, I didn't have that luxury. This year, my threshold on taxes just went, yep. So that was a good, thank you. Yeah, it's the first year, so we're still on the honeymoon, so it's good. But yes, it is good for taxes. It is good for taxes, though. There are different benefits, and you're gonna see a little bit of, a lot of the impact of being married happens on taxes. So it's good for you to be on top of it. As a matter of fact, one of those is when you sell property, right? So I put this up because I know over the last 2-3 years, people have been buying houses, selling houses. The Miami area, the South Florida area pretty much has been really hot, a hot spot with housing market. So you got to know what you're doing in terms of taxes, because most people see the profitability or the equity on the house, and they want to go and just sell it. But you got to think about, how is that going to impact my taxes? Is it a good year for me to take this money? Is it a good year for me to liquidate those assets? What should I do with those assets? So let's talk about selling house, and which house should you sell first? By the way, if you have more than one. So if you have more than one house, what's the house that you should sell first?
The one that you don't live on.
Nope, the one that you live on, your primary house. There are different rules here. There's the primary properties and there are investment properties, okay? And they call it a loophole, but it's not a loophole. It's actually a benefit that the government provides to people, to homeowners, okay? The government says, if you own a house and it's your primary house, and the rule for this house to qualify as a primary house is that you lived in the house at least 2 years out of the last 5 years. Did you hear that? 2 years out of the last 5 years. In other words, if I want to sell this house today, it's 2023. 2018, from 2018 until now, between that time frame, I must have lived in that house for at least 2 years. It doesn't matter if it was 2018 and 2019, or it doesn't matter if it was 2022 and 2023. Okay? It just, or 2020 and 2021. It doesn't matter. It just has to be 2 years living in that house to be considered as your primary house, to be claimed as primary house. And what happens is this. When you buy real estate, when you buy an asset in real estate, there's something called a cost basis. Okay? Cost basis is the price that you pay for that property. So let's say that when you purchase the property years ago when houses were affordable, and you paid $200,000 for this house. Okay? Years ago. Not now, but a few years ago. Now this house has gone up in price, and you want to sell it, and it's your primary house. And the house is now worth $500,000. Okay? So if the house is worth $500,000, if you're selling the house for $500,000, how much is your profit? How much is the equity? How much is the growth? Is your gain? it's 300, right? Perfect. So there's 300,000. Now, if this house is an investment house, you do have to pay taxes on the 300,000. Yes, there are techniques in which you can lower those taxes because you could apply depreciation to the house and remodeling and expenses that you did over time and so on and so forth. Okay? For that, you need an accountant if it was an investment house. But if it was your primary house, the one that you lived in 2 years out of the last 5, then if you're an individual, the government gives you up to $250,000 in gains that are non-taxable. You follow me there? So if it's me, just me, single, no wife yet, and I had this house, I purchased this house at $200,000, I'm selling it at $500,000. My gain is $300,000, but the government says you don't have to pay taxes on up to $250,000 out of that gain. So that means that my taxes will be only on $50,000. Remember that I told you that being married is useful for a lot of things, and one of those are taxes? Well, this is per individual. So if you're married, the amount doubles. Okay? So, yes. So if the house went from 200 to 800 and you're actually selling, now let's say that it's me and my wife, and now we're selling the house and it's our house. We bought it at 200 and we're selling it for 800. How much is that gain? 600,000, right? 600,000. But the government doesn't charge me on 5. So that means that I only have to pay taxes on 100,000. Okay?
No matter how long you're married to that person.
Yes, it does matter. Yeah, if it was recent, you cannot claim that.
10 years. 10 years. 10 years.
I will check on the amount of years, but yes, if it was, because otherwise then I'll just get married to sell my house and then let's get divorced. You cut your part and you're gone, right? The government has some loopholes, but they're not stupid. But I'm letting you know. Now, my job is to allow you to have strategies to work around, right?
But that's at the end of the year. What in the moment you sell it, what about at the end of the year? You have to pay taxes again? Or what?
Why would you pay taxes? No, you declare taxes only once a year. You don't pay, when you sell a house, you don't pay taxes when you sell the house. You declare taxes at the end of the year. Okay? Now, back to this. So, this is in regards of a primary house, right? If you have that primary house and you want to sell it, you got up to $250,000 per individual. So if you're married, $500,000 that you don't get charged taxes on, right? Now, if I have 2 houses, my advice will be sell the one that you live in first, your primary house, and do what? Move into the other one. Live for 2 years. And if you want to sell it, because then it will qualify as your primary house. Okay? I just gave you a huge tip. If you want to get rid of real estate, or anybody's planning to, or moving, or trying to do, okay?
But do you have to live there
For 2 years.
for 2 years?
Mhm.
Continuously?
Yes. Not continuously. 2 out of the 5. 2 out of the last 5.
The same.
Yes. Now, there's one trick in here. To be able to claim that benefit, you have to wait 2 years from the sale of that other house. Okay? You can't do it the next year. So, because I know some people are going to get smart with it and be like, okay, I'm going to live 2020 in this house. I'll move into this one 2021, 2022, and I'll leave 2023, and then I could sell both houses and done. No, it's not going to happen, right? That's not going to fly. Just letting you know. So that's the way that taxes work for property, for real estate. A lot of people don't understand it. Now, investment properties, right? For investment properties, you do have to pay what's known as capital gains tax. Capital gains tax could be 0%, 15%, or 20%. Most of us, the mortals, we fall on a 15% tax bracket. Okay, so if you're selling an investment home, expect about a 15% tax at least on that gain, on those 300 or on the 600, whatever it is, right? There is one rule called the 1031 exchange, in which I could take the proceeds of a property and I could purchase more property with it and not have to pay taxes on that money. Okay? In other words, I had my $200,000 purchase house. I sold it for $800,000. And it was an investment house. It wasn't my primary house. This applies to investment house, right? I sold it for $800,000. I can get those $800,000 and go purchase a new property if I want to, for the same or higher value. It has to be the same or higher value. Now, that transaction has to happen within 180 days. Okay? It's a very complex situation. You got to get professionals to get this done. Because the rule is it has to happen in 180 days from the sale of the property, but you have to know and you have to have a house under contract in 45 days. So pretty much before you sell yours, you should already know which one is the one that you're going to buy next and have that transaction ready to go. Okay? A lot of people usually ask about that 1031 exchange and how does that work and so on and so forth. That works if you want to keep passing on assets, and keep just accruing equity. But if at some point in the future you're going to sell that house and that house is going to be $2 million, guess what's going to happen? What was the initial investment? $200,000. So that means that 1.8 million gets taxed. Right. Gets taxed. I've seen that happen. Had a lady that sold a house in the Keys. When they purchased it many years ago, like 30 years ago, it was nothing. Now it's worth about 1.2 million, 1.5 million, I don't know what it was. And she was selling it. And she was going to be taxed heavily on that. How much? Oh, she will probably pay about 15 to 20%. Okay? On capital gains tax. That's where you will land. Okay? So that year, you better get a good accountant and try to lower taxes as much as possible if you're selling it. Now, if you're not planning to sell that property ever, I have some good news for you. There's something called the StepUp in basis. A lot of people don't know this. I'm giving you a lot of info, a lot of good info today, by the way. StepUp in basis. So I'll tell you the story to understand what the StepUp in basis is. Had a client the other day here. We were looking at her accounts. We were reviewing her situation. And one of the things that she told me, I asked her about her house. So I go, oh, you still have the house? She goes, no, I no longer have the house. So I said, okay, you sold it. So I guess you got more money in the bank. She goes, no, I don't have any more money in the bank. So what happened to the house? She goes, oh, I gave it to my daughter. So there's nothing wrong, no judgment. It's your house, you do whatever you want with it, right? But she handed over the property to her daughter. She did a quick claim deed and passed the title to her daughter, right? You guys understand that figure. Now, the reason why she did that is because there's still a mortgage in the house. She had made sort of an apartment on the side of the house where she lives, and she doesn't have to pay any rent. She doesn't have to pay any bills. She doesn't have to take care of the mortgage. The daughter is taking care of the mortgage right now. Okay? So in her mind, that was the good trick, right? Now, one of the things that I told her is, you made a mistake because you should have allowed your daughter to keep paying the mortgage, but keep the mortgage under yourself and keep the house under your name. And the reason why I will advise you to do that is because there's something called the StepUp in basis. When you die, the government is going to increase the value of that house to the point where it is at the time of your death. That's the step-up in basis. In other words, back to our example. If I bought my house for $200,000 and I kept my house and my house went up to $800,000 and I die when it's $800,000 and my kids get the house, now the government tells them that they received a house that is worth how much? $800,000. How much tax do they have to pay?
Nothing, because they got
Zero, because of the step-up in basis. They will increase the value of the asset, whether it is stocks, mutual funds, bonds. They will increase the value of the asset up to where it is at the moment of your death. Do you follow me there?
At the market price.
Yes. Yes. Okay? So you just saved your kids taxes on $600,000. Now, if I did what she did, if I did a quick claim deed when it was $200 and I handed it over to my daughter and my daughter had it and then it went up to $800 and I died and she sells the house at that moment, she has to pay taxes on the $600,000 because it was growth. Do you see that? So yes, it's more like a legacy play, but you got to know that. It works for stocks, it works for mutual funds, it works for bonds and tangible assets. Okay?
So the daughter, if she keeps it in her name until she dies, the daughter gets it at $800,000, and when she sells it, she only pays on what's above that.
Oh, what's above the $800,000?
Right.
So that's a win for. You know what millionaires do? They die with their house. Because when they die, that goes to their heirs and then they receive that price. And now if they sell it, they don't pay taxes on it. If she decides to sell it at $800 flat, she doesn't pay taxes on it. If she sells it at $900 or $1 million, then she only pays on $200. You see the benefit? Just letting you know some stuff.
I have a
Is that only for primary residence or for all properties?
Nope.
All properties.
Yep.
What happens when
For all
you
properties.
sell the house,
Step up in basis, yes.
sell the house for $1, like I see?
That's a quick claim deed. That is exactly what she did. She transferred the home ownership to the daughter, right? Now, I trust my kids, and I love them to death, but I'll just keep the house, just in case. Because I trust my kids. I don't trust whoever they get married to.
In a trust? In a trust?
If it's my primary house, no, not necessarily. It depends. It depends on what do I have, right? She's asking, by the way, she's asking, I'm sorry, I think we got linked up to the live stream now. So she was asking if I should keep my house in a trust. So it depends on your situation. The trust will allow you to pass on assets to your kids in a specific way, right? Or to your future generations, not just your kids, future generations, right? But then for that, it depends on what you have, how much.
If they are married.
Yeah, if they're married, it goes to them, and now they have their, significant other. And if they don't work out and they split, then 50% is that. You know the whole deal, so you want to protect as much as possible, right? That's the intention. So, yeah. Quick update on contribution limits for this year. We're talking about taxes today, so obviously this had to come up. Every year, the government increases contribution limits for all the retirement plans, right? For those that are still working, 401k contribution limits were $20,500 for anybody that was under 50 years old. It increased to $22,500. And then there's something called the catch-up contribution. Anybody that's over 50 years old, they can do another $6,500 into that 401k or that 403b if they want to, okay? And put it tax deferred. They increased that $6,500 from last year to $7,500 this year. Okay, it was a $1,000 change in that. So for people that are putting money away in their 401ks, 403bs, That's the thing, right? For total contribution was about $61,000, meaning you and your employer. This year, it will be $66,000 you and your employer. If you're under 50, if you're over 50, it goes to $73,500. Now, 457 plans. This is for anybody that works for the state, any state employee, right? Has a 457, 20,000, or you have a deferred compensation plan. 20,500 went up to 22,500. Traditional IRAs, individuals that have traditional IRAs or Roth IRAs, the contribution, if you were under 50, was 6,000. It went to 6,500, and the catch-up contribution is still 1,000. So those that are over 50, then you get to do 7,500 this year. Same thing for the Roth IRA. SEP IRAs for business owners went from 61,000 to 66, and the simple IRAs went from 14 to 15,500. Okay. Health savings accounts, if you're single, 3,650 was last year, went to 3,850. And if you have a family contribution, 7,300 went up to 7,750. Those health savings accounts are accounts that you can use for medical purposes, right? Yeah, when you're married, you get certain benefits, like I said. Yep, I know. Now, this is something that I found that was very interesting. A lot of people think that we are in a high tax environment right now. A lot of people believe that taxes are just ridiculously high today. And what most people don't know is that we are at the lowest taxes we have seen in the last 40 years. People don't believe me, but this is how taxes, or this is the tax story, right? Back in 1913, it was about 7% when it started. You know what happened in 1914? World War I, right? And look at what happened to taxes. Where did they shoot up to? Almost 80%. By the way, this one is tracking the highest tax bracket. So not everyone went up to 80%. But someone that was paying 3% here, at least was paying around 10, 20%, right? And remember, these people that get taxed this much, they got millions. They got money to pay. People that are here on the low bracket, they don't make that much. So sometimes people don't understand that 1 or 2% increase or decrease is either really hurtful or helpful for the little guy. Okay? It is hurtful and helpful for the bigger guy, but the bigger guy can take the punch. 2 more % in my increase, I'll pay it. I make millions, I don't care. Right? But us, the regular Joes, we get a little bit screwed when that happens. Yep. So taxes went up. Then after the war, we went down, and we had the flourishing 20s in the country, and the higher tax bracket was around at 25%. And then the Great Depression hit 1929, 1930. Taxes started to go increase. And then remember what happened in 1941, was it?
Yeah, 1940 actually.
Right, 1940, World War II.
Well, was 41, but
right.
World War II, 39 to 40.
So taxes went all the way up to 94% for the higher payers. The higher income earners pretty much were working about more than half of the year just to pay taxes, right? And obviously, our duty as citizens is to do that because we're not over there fighting the war. There are others that are doing that, right? And so, yeah, that sucks, and we don't make the decision, and we can go into that argument again, but the government makes that decision. We just have to roll with it. But that happened. People don't truly believe that. I exhort you to go look it up, right? And then when most people will say, well, I'm never going to be that rich, so let me find where the poor were. So find where the poor were, and you come and tell me, right? taxes began to slow down and come down by the 60s, 70s. Around 81, Reagan becomes president, and then taxes dropped drastically. And when we got to the 90s, taxes were on the 40 rate. Okay, and they stayed there for like about 10 years. The high tax. Okay. Then they went down, and then they went back up, and then in 2017, 2018, when Trump came onto the presidency, he lowered them. And that's where we are right now. This one only comes up to 2020. The reason why I wanted to give this tax history lesson thing is because Donald Trump signed this thing called the Jobs and Tax Cuts Act in 2017. And the expiration of that act is 2025. So by 2025, if Congress doesn't do anything about taxes, taxes will go back to that 40 rate. Okay? I wanted to, make it numbers-like so you could understand it. Taxes in 2017 started at the 10% tax bracket, as you see there. And then they went to 15%, 25%, 28, 33, 35, and 39. When that tax cut happened, the 15 turned into 12. That's 3% less. The 25 turned into 22. That's 3% less. The 28 went down to 24. That's 4% less. Okay? Let's not keep going, because after that, we could go up to the 33, went down to 32. Yes, because I'll say that some couples might be around that $300,000, But what I'm trying to tell you is, and this goes hand in hand with the Social Security tax and the whole conversation that we're having at the beginning, does it make sense for you to get that money right now, or it doesn't? Your accountant probably will tell you, no, it doesn't, because you're going to end up paying more taxes, right? And we might tell you, well, listen to your accountant, and then when 2025 comes, instead of paying 22%, as you would have paid today, you might end up paying 25. Do you see that happening? That's 3% more. Okay?
Now, is that figure at the very end the gross adjusted, or in other words, the married filing?
Yes.
It's adjusted.
Yes.
So whatever you make, but deduction.
Right.
That's what that is.
No, it's your total income. Yeah, your gross income.
The gross income before the deductions.
Mm-hmm. Now, that's for 2022. This is the one for 2023. Because obviously we're going into this new year. They usually increase a little. It's not much. Not a lot of change. But what I'm trying to tell you, or what I graphically wanted to tell you here is, we've been saying a lot about moving from taxable to tax-free, or using tax-free strategies, or using tax-free vehicles, right? We are in that time frame in which we can switch that. We can make that switch from IRAs to Roth IRAs. We can start making switches from, retirement plans, or taking distributions and paying taxes on that money, and, investing it in a tax-free vehicle. That's what I'm trying to tell you. And we got about 2-3 more years of that. Unless Donald Trump comes back, like a client told me the other day, right? Because if he comes back, then he will extend it. That's exactly what he said. To which I responded, I will love the guy to come back, but if he doesn't, at least you were able to pay some taxes at a lower tax bracket, okay? Because government is going to increase those taxes, especially after all the spending that we've done through the pandemic and the Ukraine war and all these things, right? So that's that. For those that have IRAs or retirement plans, and don't need that money because they might have a pension, they might have other assets, they might have rentals, income coming through, and they are not going to use that IRA money, okay? Because we do have some clients that are going to need that distribution, and there are some clients that are not going to need that distribution. Or there are some clients that are going to need a portion of that distribution, not everything, okay? But they're not going to run out of money. They're not going to spend it all. So I wanted to run you an example of a 65-year-old person with an IRA value of $250,000 that doesn't need that money at all, okay? They don't need that money to survive. They have a pension, or they have income from rental properties, or they have any other, or their Social Security is enough, plus the rental or plus the pension, and they don't need this. I actually do have one lady that just retired from the state in this exact situation. She's got a good pension, and within less than a year, she's going to claim Social, and she will have a surplus every month. So she doesn't have an income issue. She's got a good pension from the state, and she gets her Social in about a year, 8 months, and she's really good. So she has whatever she accrued in her drop that she's not going to touch. She's not going to use it at all. Or at least she's not planning to, right? So what we went through this conversation, and I told her, if you have this 250, and her amount is different, but let's say that it was 250, right? And we put this money to work into the stock market for the following years, right? And you don't touch it, and you start taking money when the government tells you you have to, which, by the way, I give you a little update. The RMD was 70.5 back in 2019, okay? By December of 2019, they moved up the age to 72. And guess what the government did just recently in December?
7.
They moved it to 73, okay? So if you have a retirement plan, I know this graph is showing 71 because we had it as 70.5, but it's not 70.5, it's not 72 anymore, it's 73. Anybody that turns 72 this year, they're not obligated to take their RMD. They can wait until next year, okay? And then in 2033, they're going to push it to 75. But that's 2033. That's 10 years from now. So it's a long way. But if you have to start taking money, the government will demand that you take a portion of it. In this case, it's counting that you take about $13,000 from that IRA, which started at a value of $250 and it increased to $361. So you definitely have to pay taxes on that $13,000 distribution, right? We just spoke about that. Mm-hmm. Now, we're counting taxes at a tax bracket of a 22%, which is where most regular, people fall into. Some are able to lower it to a 12%. Those are doing amazing. But in terms of taxes, maybe not income. But usually people that will have a steady income, like a pension or something, will fall on a 22% tax bracket. So you pay 22%, which is $2,900 on that distribution, right? If you don't need that distribution, usually what you do with that money, you look for a good financial advisor, good looking, young, smart financial advisor, right? Recently married, that will tell you where to put that money to work, right? And if you put that money to work, then you reinvest the $10,000. Now, if that advisor is good and provides growth on that money, on the growth of that money, you're going to have to pay taxes again, right? Because it's growing. So we're counting capital gains tax in here of about $108 on the growth of those funds being reinvested. Now, remember that the plan here is that you're not going to spend that money. You're never going to spend that money, okay? If we run you from the 70 all the way to 90, the value of the account, if we did a good management, will be about $476,000 at that moment, because you're not depleting a lot of money. You're just taking whatever the government tells you to take. But at that moment, you would have paid in total taxes for the distributions about $114,000 in taxes. For all those years of taking $3,000, $13,000, $14,000, $15,000, and so on and so forth. I know, I don't make the rules. Now, if you reinvested that money, and that money was reinvested in the stocks or in the stock market or in mutual funds because you wanted that money to grow aggressive, then you will be taxed on that gain, and that gain will be another $55,000 of taxes in total. So if you add the 114 plus the 55,000, that's about 169,000, right? Now let's say that you kick the bucket at 90. You made it to 90, and the Lord called you, right? And now that money goes to who?
Your heirs.
To your heirs, your family, whoever you listed there, your beautiful kids. Now, do they have to pay taxes on that money? Of course, it's taxable money, and you know what? Uncle Sam is not going to let him get away with it. They're going to charge taxes. So that's another $176,000 in taxes approximately they will have to pay. So you kick the bucket at 90, and you paid a total of $346,000 in taxes. You know, counting whatever you paid plus whatever your kids paid. Yeah? Now, they still get a good check. They still get, out of the $476, they pay $176. They still get $300,000. They're well off. But they could have gotten $500,000 pretty much, right? So if that is the case for someone that doesn't want to use their money, they're not going to spend their money, that's when financial advisors come in and give you strategies on how to preserve that wealth in your family. And now all of you know your own numbers, right? Those of you that are watching too, you know your numbers. You know your IRA amount. So that IRA amount is going to get hit when you pass away because your kids are going to have to distribute that money. And now with the rules that we have, they have to distribute it within 10 years. Okay? Before, it used to be over a lifetime. Now it's within 10 years. So they're going to get hit with taxes. Now, if you want to preserve wealth in your family, it's a quick, easy fix. Start using that distribution to fund a life insurance policy that's going to offset whatever taxes you have to pay. This is what rich people do. Now, rich people do it for a reason. We just think that it's not worth it. But you use that money and you fund that policy, and maybe that policy passes on $500,000 additional to the $300,000 that they're receiving, and those $500,000 are going to be tax-free. That's how you preserve the legacy in your family. That's how your hard work pays off, right? Because you obviously, there's no way to beat the government. I mean, come on, they make the rules. It's, you know, it's crazy to think that we're going to, at some point, tell the government what to do and how to handle taxes. But what we can do is get prepared for it, right? And if there's money that we don't need, we have to put it to work somehow in the most efficient way. And that's what we're here for, right? So that's a strategy that we have for our clients, and I wanted to let you guys know. Taxation on accumulation vehicles. I thought this was interesting for people to know. We got tax growth, we got tax deferred growth, and we got tax-free growth. Tax growth is stock accounts, brokerage accounts, CDs, money market funds, savings accounts, and then Social Security, as we learned today, up to 85% depending on your income, right? So that's going to be taxable, expected to be taxable today, tomorrow, you know, and always. Then we got tax deferred growth. Tax deferred is just tax postponed. I'm not paying the tax on that money today. But that doesn't mean tax-free. I'm going to pay it at some point. If I'm not going to pay it, my kids are going to pay it. But someone's going to pay it. Okay? 401ks, 403bs, traditional IRAs, tax-deferred annuities, savings bonds. Okay? Some of those are going to be tax-deferred, but you're going to pay the taxes when you pull the money out. At what tax rate? Because that's the question. It depends on where you fall in that moment. It also depends on where the brackets are at that moment. Remember, taxes today are different than what they were 20 years ago, and they're going to be different in the next 10 years as well. I can assure you that. And you guys know this, right? So, knowing that. Tax-free growth, Roth 401ks. They started offering Roth 401ks, I think it was in 2015. Not all companies have it available, but most companies do. Some companies, I had a meeting with a young girl today, client of ours. She's the daughter of one of our clients, and she's working at Citibank now. She was working at Chase before. She moved to Citibank, and she's got her 401k, and all the contributions that she's doing is going to Roth because she does understand what we're doing. She's putting money away in a tax-free vehicle so that she doesn't have to pay taxes in the future, because she understands that she's better off paying today that 12% or 22% versus paying at 25 or 30% in the future. She doesn't know. So she'd rather pack as much money in there. She's also funding a Roth IRA. She started doing that last year. Smart girl, by the way. She's getting married this year. Well, I don't know if this year, but she got engaged. Had a conversation about that too. Life insurance, like I mentioned, it's a tax-free vehicle. Okay? It's the way that I could pass on legacy to people, to other people tax-free. It's a way in which you could also shelter money in an account and get it tax-free in the future if you wanted to. Okay? Municipal bonds. Municipal bonds are also tax-free. But not everybody goes into municipal bonds because the interest rate that they pay is maybe not so attractive nowadays. Okay? So, wanted to let you know that, see where you are. If you need to make any changes, that's what we're here for. Now, there is one little issue with the Roth IRAs. And I talked to this girl today about it because it depends on the amount of income that you make. If you make over a certain amount of income, then you cannot contribute to a Roth IRA. Okay? If you're married, filing jointly, and you're under $218,000, then you can contribute to a Roth IRA. You could put money into a tax-free vehicle. If you're between $218,000 and $228,000, you could contribute a reduced amount depending on where your income is. Okay? You have to do the calculations. If you're over $228,000 of income, then, and this is AGI, then you cannot contribute to a Roth IRA. Okay? As a single person, 138. Between 138 and 153 is a reduced amount, and over 153, you don't get to have that benefit. So people that are making money, they can't get that Roth IRA vehicle in their life. They have to use other things such as life insurance, like I mentioned. So we've built some plans for some clients that are structuring that figure. You know, even young people nowadays, we have people that are making enough money through, you know, Facebook ads and marketing and things like that, and they're cashing in $10,000, $20,000 a month, and they, you know, they're wondering, where do I put my money? I can't use a Roth IRA. I'm making over the limit. So if I'm making over the limit, where do I put money into a tax-free vehicle? There comes that strategy of that life insurance bucket so that it could be tax-free, and then you could cash out in the future as a retirement plan. You build your own retirement plan, right? So that's another tip for you guys. Well, what's next from here? To have a comprehensive plan. If you're working with us, you probably already do have one. If you feel that you need to check it, or you need a tax reduction strategy, or you need to talk to any of us about where's your tax situation and how we can fix it, you know, that's what we're here for. We got about 5 advisors in here, right? Sebastian, Mauro, Jimmy, Tyler, myself are at your disposal to have meetings and review that. Do you have a tax-free strategy or a tax-free legacy? I don't know. You know, question yourself. We're starting the new year, so you got time to get stuff done. And don't let it sit there until the end of the year, because you already know what happened in 2022 with the things you wanted to get done that you didn't. So act upon it right away. My wife tells me that all the time. You have to get it done, right? And I'm good at some things. There are some other things that I'm not so good, but she's there to remind me, keep me in check. Can I do this by myself? Some people will be able to. They're smart enough. Most people need a little bit of help. Okay? And that's what we're here for, once again, to provide that. Okay? And then, last but not least, who else needs to hear about this that you know? Okay? We do this seminars every 2-3 weeks. We got one English version, one Spanish version. It's the same information, might be delivered a little bit different. It's for clients, but if you want to bring guests, you're more than welcome. Okay? I believe that we're sending some text messages to let you know that if you want to connect for those clients that signed up. I know that there are clients that called and maybe for whatever reason they got stuck in traffic, they won't be able to make it, they got something at work because we were expecting about 30 people. But right before we started the seminar, we sent out a link as a text message so that those people that couldn't make it could actually watch it. So we got some people watching it. It started a little late because we had some technical difficulties, but they're watching it. We are recording this and we're posting them on our website. So the reason why I'm telling you is because you could redirect your kids or whoever you want to our website, to that link, and tell them, hey, go listen to these guys. They got something important to say, maybe. Maybe you like it, maybe you don't. I don't know, right? But it's worth a try. And I'm pretty sure that if they drive, they could just play it and listen in the background to whatever we have to say. And they might come up with some questions. They might find some answers. Okay? I can tell you as a younger person, some of us think that we're a little bit smarter, but we do find other people that are smarter than us. And then we catch on to and we grasp on and we realize, okay, we got to talk to these people for some reason, right? And I know you've been probably telling them, hey, do this, do something with, and they might not listen to you. And then another person comes that works in this area and says the same exact thing. And then they will be like, that is gold. And they'll act upon it. You're laughing because you've heard it before, right? You know, I'm a kid. I was a kid once, right? Now I got kids. Now I see it. They don't listen to certain things that you say, but it's okay. Time will come. Time will tell them, right? But if you do have that, or you have those friends at work, or you have family members, or anybody that does need our services, that's what we're here for. And we got a great team, by the way. I think that when I was opening this, the first thing I opened, the page I'd opened was our page. And so we got our founder, Mauro. We got his 2 kids, Sebastian and Fabian. We got Jimmy, Tyler, and then this handsome guy, Miguel, as an advisor. He's off the market. So we got a team of operations. You met Magda, and we got Julie, which is our director of operations. We got Piedad, that used to be part of our team actively here in the office. Some of you met her. She's still working with us, but she's now handling all the personal matters for the partners of the firm. And we got Erasmo that does consulting. He comes on and off with the team. Got a full marketing team. These are the girls, the women, the amazing team of marketing. Okay? All these women are exceptional. They're really good at what they do. They put these things together. Okay? They put these ones together. They put the ones outside together. Now I believe next week we're going to be visiting a teachers conference because we have a client that's involved in, with a teacher board or something, and we got invited to speak about the FRS, to talk about the FRS to teachers and retirement and getting them set up, And I have a high respect for teachers. People usually tell me that I'm a good person to teach and that I will be good at teaching, but I really admire people that have the patience to deal with 30 kids, or 20 kids, or 5. I have 2 at home, and that's already hands full, so it's a lot, right? And as teachers do prepare our future generations, we want to make sure that themselves are ready for what's coming at retirement, right? Which is like the next 25, 30 years of your life when you're done working. So they do an amazing job. Nancy's here. Nancy's in the back with us. So if you do want to set up an appointment or invite other people, you should have like 2 different cards. Yellow one to set up appointments, this to invite other people. Just hand it over to Nancy so we can get that done. We have in your relations team, Steph, Janelle, Max. They talk to new people coming to see us. They set up appointments. We added a few team members. They're not there yet, but there will be soon. Blanca, and we got Andre, and we got Jocelyn, and Sebastian, another Sebastian. We have a new business team. This is kind of the muscle work. They do all the paperwork. They set up the accounts, do the transfers, and do a lot of the stuff. Some of the faces, names, maybe you recognize. Maybe you talk to if you're our clients you work with. And we have the client service team where there is the other Miguel, the newer, prettier version. Yeah, there's a prettier version, a better version for everything, right? So there had to come another one, and his name is also Miguel Angel. So it's funny, and he's as good as I was when I was his age, and he will probably be better than what I am when he gets to my age. That's for sure. So that's the team at your disposal. If you need anything, just reach out to them. Thank you for coming tonight. Thank you for taking the time. I hope it was useful. And if you have any questions, if you need to meet with anybody, just reach out to the office, and send anybody our way. I want to say goodbye to whoever was watching today, listening. Same thing, if they want to set up an appointment, I think that a link is going to be shared to them so that they could, contact the office. Even if you're clients and you need an appointment, also use the link and contact the office, because that's what we're here for. Thank you very much. Have a good night. Drive safely.